If you're like most investors, you got hit pretty hard at the end of last year. That fourth quarter of 2018, whoo, a doozy. According to Oppenheimer, investors pulled out, get this, $200 billion out of equity mutual funds and ETFs from October through the first week of January. In money markets, they grew by like $209 billion last year, more than the previous 5 years combined. Think about that. It's crazy stuff. While some people may have pretty good reasons to jump out last quarter, it's likely that a large number of investors did it simply because of fear. So let's recap what we saw. We saw the NASDAQ down 17%. We saw S&P 500 down 14%. The Russell 2000 down 19%. With such a big drop in one quarter, and let me tell you, it was a big drop, there is human instinct to try to do something about it, and I get it. The problem is that doing something almost never works out well. And history shows us that the worst days in the market are very often followed by some of the best days in the market. And when fearful investors bail out at the trough, they miss out on any recovery, like the 8% total return gain we saw in the S&P back in January. So given all that, it's a good idea to remind ourselves of a few things, okay? So first, corrections in the market, they just happen. They do it almost every year. The median intra-year peak to trough decline of the S&P 500 index over the past 40 years is 9%. And on average, it takes about 8 months for the market to get back to its previous high. So what? That's what you're investing for anyway. You understand this. You should also remember that it's rare for the broad market to post negative returns for 2 straight years. It's really only happened 3 times. Once in the 70s, once in the early 2000s, and back in the Great Depression. We don't see any signs of those types of market conditions happening again anytime soon, right? Then the third thing, keep in mind that stocks have historically gone up more than they've gone down, right? Since 1926, equities has posted positive returns over a 10-year period 94.6% of the time and 99.8% of the time over any 15-year period, right? Think about that. And they far outperform money markets or government bonds. I mean, a $1,000 investment in T-bills in 1926 is worth around only 20 grand today. That same investment in U.S. small company stocks, it's worth like $5 million bucks. So, you know what? Stick to a plan. That's what we do here at Lucia Capital Group, right? It'll help you resist the first impulse to sell in a panic because, believe it or not, sometimes the best thing to do is do nothing at all. Call us. We're here to help.